Matt Luzzetti with Deutsche Bank and the team over there absolutely nailed a graceful recession call years ago that came out and they said, there's going to be a recession off the pandemic. But the first day they said it, Paul, they said, we don't know when. And they had a huge humility at the time, trying not to cherry pick the gloom of recession. And so there we are. It really hasn't happened.
It hasn't happened.
All that stimulus and an update here as we go into all this labor data. Why don't you bring in Mr. Luzzetti?
Exactly. The economic data has been solid. Inflation coming down. It's, the question is it a soft landing? Matt Luzzetti joins us. He's the chief U.S. economist for Deutsche Bank. The last time I saw him, Tom, was in the Vail airport. And I said, hey, how was your skiing? He didn't ski. He was out there for business.
Oh, yeah.
Who does that?
Oh, yeah.
It's just
idiots.
Immediately I took my II vote away from him. So, Matt, thanks so much for joining us here. As Tom was saying here, this economy, I guess, what do you guys make of it, Deutsche Bank? I think most people, the marketplace broadly defined, is pleasantly surprised about the U.S. economy, particularly relative to other parts of the world.
You have to be pleasantly surprised. I think if you look back to 2023, it was the best possible outcome for the economy, the best possible outcome from the Fed's perspective. You had above 3% real GDP growth. You had the unemployment rate down to 3.7%. And over the back half of last year, you had core PCE inflation, which is what the Fed focuses on, below 2%. That was a remarkable outcome, I think, for a Fed that raised rates by over 500 basis points that was undertaking a very aggressive QT outcome. Question is, where do we go from here? We still now continue to see this very resilient economy continuing, the labor market looking resilient. We'll get an update with data this week. Key question will be, especially from the Fed's perspective, how much of the disinflation trend that we got last year continues, or is the strong inflation prints that we got over January and February, is that a new trend that we're seeing?
How do you guys think about that? Because that's probably one of the forefront issues for the market is, are we seeing a resurgence in inflation? What do you guys think?
Yeah, so you have to acknowledge, I think January was a very strong inflation print. And when we got data last week, core PCE was actually revised a little bit higher. February was better, but not good enough from the Fed's perspective. I think when you look at the components that drove it, shelter inflation, both in January and February, was higher than anticipated. We do continue to expect that will come down. We have these private sector estimates of rents that have come down a lot. So I think that's still going to happen, but it's more uncertain than it was 3 months ago. And when you look at these other core services items, there was actually a lot of disinflation in them in the February data. I thought that was a good data point from the Fed's perspective in terms of supercore.
The morning after the invasion of Ukraine by Mr. Putin, David Folkerts-Landau of Deutsche Bank was adamant that we would see government stimulus, we would see fiscal policy across Europe and across the world. Clearly, we've seen that in the United States. Is this great underestimation of our boom economy, is it just because of the 3 stimuli we had?
No, I think it is absolutely part of it. If you look at the budget deficit last year relative to the unemployment rate, we were running a very loose fiscal policy relative to the stance of the economy. But that's not the only thing. I think we've seen greater focus on the supply side of the economy, especially from the Fed, and there's great work from Brookings, the CBO recently, just looking at net immigration flows, how much that added to the labor market over the past year, and was this really positive supply side story for the economy. I think it allowed us to have strong growth, but disinflation as part of that. And then you just have to say that the Fed's monetary policy tightening was probably just had less traction than anticipated. Markets didn't crumble as much as I would have thought under a 5% Fed funds rate. People were able to lock in low interest rates, so mortgage debt ratios are still quite low.
So where's your real and nominal GDP run rate right now? Going on 3-4 quarters.
So I think if you look at what I think potential growth is for the economy, at least in the near term, I think it's probably closer to 2.25 or so. I think it's meaningfully above what the Fed has
real
in their own
GDP
forecast.
Potential.
Real GDP potential.
Right.
Now, I think that there's obviously lots of uncertainty around that. The labor supply story has been really important there. But I think there's a really constructive productivity growth story for the U.S. economy if you look over the next several years. Now, part of that could certainly be AI. We as a House are very constructive on AI, but I think there's a lot of uncertainty in quantifying that. The reason to be positive is that you typically see tight labor markets followed by very strong productivity growth. And the idea is that firms are forced to do capital deepening, do CapEx, find productivity enhancing projects.
Paul, we call that the Boston Red Sox. They're forced to find productivity.
So, Matt, given that backdrop, Matt, what's our Federal Reserve going to do? I mean, I don't know. We started the year thinking 6 rate cuts, and now we're pricing less than, 3, maybe a little bit less than 3. How do you guys think about that?
Yeah, so we have them cutting first in June.
Okay.
I think what we've heard almost uniformly from Fed officials is that they're not in a rush today. And they're not in a rush today, both because the economy is hanging in better than anticipated, and so there's no urgency to cut, but also because inflation has surprised the upside. So there's greater uncertainty about the disinflation trend. I think if you get softer inflation prints over the next few months, the Fed probably does cut in June. But I think the bigger question will be, what does this overall cutting profile look like? And I think there's a very strong case to be made that perhaps the Fed only does 2 or 3 insurance cuts. We think of it as a little bit more of a mid-cycle adjustment, and that any cuts beyond that become a lot more uncertain.